Hello, in today's video we'll be taking a look at the Thursday, February 26, 2026 trading session for the SPX CBOE index. We'll be trading 0DTE SPX options utilizing the new SPX daily key levels V 3.0 indicator, which was just released about 10 days ago. Okay, so some of you may already be familiar from watching our other SPX videos on this channel about the SPX daily levels indicator and how it works from seeing our SPX session videos utilizing the previous version, the V 2.0 indicator. This is now the V 3.0 indicator, which has lots of new additional features. For those of you who are not familiar with the SPX daily key levels indicator, this is going to be a condensed, shortened video that's going to be a lot shorter than our typical videos, so please look in the description of this video for links for a general overview of the SPX Daily Key Levels Indicator for a video on the overview of that, as well as a video on the new features in the V 3.0 version for a link on that as well. Okay, so in today's session, we have the SPX Bull Bear Key Price Levels, which we have here abbreviated as KPL, of 69.52.65. We have our optional range filter turned on for the 9:30 a.m. opening candle to tell us whether the opening candle is either closing above or below today's BBKPL level, and the alert will only show if the candle close is in the acceptable trading range for a trade off of today's bull bear KPL in either direction. So here we have the alert popping up that this candle is closing below today's BBKPL. That's our bearish entry signal for a trade taken off the opening candle. And the alert popping up also shows us that the candle close is within the acceptable range. So we're getting two confirmations here. One, that this is a close below the BBKPL, and the second confirmation via this alert is that it is within the acceptable trading range. With this indicator, your stop loss levels for a trade off of the BBKPL level are going to be two different ones. One is your standard stop loss level for a BBKPL bearish trade is the first midpoint level above, which is the mid BBKPL R1 level here. Or if you prefer to use a tight stop loss level on your trades, then the QL level above the BBKPL is your tight stop loss for a bearish trade taken off the BBKPL level. Now with this indicator, you have three different strike options to pick on any bullish or bearish trade that you do, depending on the level that you're taking the trade from. And the process for doing that is as follows. So since we're taking a trade off the SPX Bull Bear KPL level, and we have a bearish trade, the way that you work out the three different option strikes that you can choose from on this particular trade is the standard play is going to be your first option. The standard play is going to be the closest strike price to the level that you're basing the trade from. In this case, we're basing the trade from the bull bear KPL level, 69.52.65. So our closest strike to that is going to be the 69.55 SPX 0DTE option. We have an ask price on the 9:30 a.m. candle close of 24.60. We're on a 2-minute chart. If you've seen our other SPX session videos, the recommended chart time frames to use this indicator are from 1 minute to 5 minutes, with the recommended chart time frame being the 2-minute chart time frame if you're going to be using this indicator for our daily key level strategy. If you're going to be using this indicator for other strategies such as vertical spreads, iron condors, butterflies, or any other type of option combination trades, which could also involve strangles or straddles, then depending on the strategy you're using, you may want to use a different time frame, leaning more towards the 5-minute time frame, 10-minute or 15-minute, or even 30-minute time frame, depending on the type of strategy that you're employing. But for the daily key levels strategy that we outline in all of our session videos, the 2-minute chart time frame is the recommended chart time frame for utilizing this strategy. Now, how do you determine the other two options, strikes that you have as alternatives rather than the standard play? First, you look at the level you're taking the trade from, the direction you're trading, which in this case is down since it's a bearish trade, and you look to the first midpoint level below the main key level that you're trading from, the bull bear KPL, and that's going to be this level here, the mid BBKPLS1 69.4289. So that strike, the closest strike to that is going to be the 69.45 put option for this particular trade. And what would be the furthest out of the money strike you can consider, and the third option strike you can consider on this trade, is you're going to do the same process, except you're going to look one full level down, and one full level down in this case from the level we're taking the trade from is the S1 level, 69.3313. So the closest strike price to that is the 69.35 put option. So those are your three different strikes you can choose from depending on your risk reward profile, how much money that you want to put into this trade, and also your general risk overall. Generally speaking, the out of the monies are going to pay off a lot better compared to the amount of money you're putting in at the beginning of a trade. However, the trade does need to move more in order for those to achieve the same type of profit level that you would with the standard play. So that's up to the trader's choice in this particular strategy. However, just keep in mind that with any bullish or bearish trade off of any main key level with this particular indicator, there are always going to be three different option strikes that you can use, and you would use the same process whether it is a bullish or bearish trade. For example, if instead we were looking at a bullish close on the BBKPL and we were instead looking at a bullish trade, then your tight stop loss for that, taking a bullish trade from that level, would be the QL below the BBKPL, and your standard stop loss in the case of a bullish trade off of this level would be the first midpoint below. And it works the same way off of the other main S levels or main R levels. You can also take bullish and bearish trades off of the pre-market high, the pre-market low, the YDC level, the YDH level, and the YDL levels with this particular indicator. For those trades, you can choose either a tight stop loss or a standard stop loss, but you would do so in the user control panel and then scrolling down to the trade section for PMH, PML, YDH, YDC, and YDL trades, and then you would select to use either a standard stop loss or a tight stop loss, and the indicator will plot the stop loss level for those particular levels and that particular type of trade on your chart, and then you would pick the reward to risk multiplier you would like to use for that trade, which can be anywhere from a minimal scalp of 0.25 to 1 up to a maximum of 30 to 1 for looking for extended move trades. However, the default setting is a reward to risk ratio of 2 to 1 because that is generally the minimum that you would want to use with most trades. However, that is again up to the trader's choice. If you're looking to do minimal scalps and you want to go under the 2 to 1 ratio, that is up to your choice. However, that is the default. Or if you're looking for more of a maximum reward type of trade versus your risk, then you can go all the way up to a 30 to 1 reward to risk ratio. Okay, so we're entering the trade on the candle close because we're waiting for the close of this candle to confirm both the direction and that it's also within the acceptable range. Now here we have the data boxes from Thinkorswim for the 9:30 a.m. candle close, which of course on a 2-minute candle is closing at 9:32 a.m. And we have the 3 different strikes here. So the ask price on the 9:30 a.m. candle close for the 69.55 put is $24.60. For the 69.45 put, it is $19.70. And for the 69.35 put, it is $15.60. Now with the daily key level strategy, there are 2 different types of trades that you can do. One is a scalp only trade, and when you're taking trades off of any of the main key levels, which would be in this indicator, the bull bear KPL, or any of the R1 through R6 levels above, or any of the S1 to S6 levels below. You're looking for a 1 level move in your favor for a scalp only exit. And on scalp trades, generally you want to exit 100% of your contracts on scalp only trades, whether that is 1 contract that you're trading, 2 contracts, 3 contracts, 5, 10, or 20, or what have you. So although with scalps you could adjust a scalp and turn a scalp into a regular trade, generally speaking, it's best to either look at every trade as either when you go into it as you're looking for a scalp only, and you have your defined exit, and then you can execute the trade based on a scalp only move, or that when you go into the trade that you can do the other type of trade with this daily key level strategy, which we call a regular trade. And with a regular trade, you are looking for a minimum 1.5 level move in your favor, and then you have many different options depending on how many contracts you're trading and what you're looking to do with that regular trade, which we'll get into in just a moment. Okay, so here we have a 1 level move down from the bull bear key price level to the S1 level. So how you define the move in your favor for the exit or for an adjustment on a regular trade is going to be looking at the level that you're taking the trade from, in this case the bull bear KPL level, looking in the direction of the trade, which in this case is down since it's a bearish trade, and 1 full level down is going to be the S1 level. So that would be your exit on a scalp only trade. So 1 level minimum required move for a scalp. And then here are the bid prices on the candle close. For the 69.55 put, 31.10 is the bid here on the candle close of the 9:40 a.m. candle. That's a profit of $650 per contract. On the 69.45 put, the bid is 25.30 on the candle close. That is a profit of $560 per contract. On the furthest out of the money 69.35 put, the bid is $20.50 on the candle close, and that is a profit of $490 per contract. Now on the 9:44 a.m. candle, we have a hit of the mid S1, S2 level. That is a 1.5 level move, calculating it from the level that you're taking the trade from, the bull bear KPL, down to the mid S1, S2 level. So that is your trigger on a regular trade because that is the minimum threshold, the 1.5 level move. At this point on a regular trade, you have several different options to choose from. One option is that you can simply exit the trade like you did scalp and exit all of your contracts. The second option is that you can adjust your stop loss to break even being the price you paid for the option, or break even plus a profit buffer. Now, generally speaking, you'd want to add a minimum profit buffer of 10%. You could add a lot larger profit buffer than that, maybe up to 15%. However, you want to give your trade room to breathe. So generally speaking, you would want to leave it either at break even or break even plus a minimal profit buffer of somewhere between 10 and 15%. If you make the profit buffer too large at this point, you run the risk of beginning stopped out, which if you still have a large profit buffer is not the end of the world because you would still have the profit built in from whatever percentage you put on it. However, the idea is that we're trying to uh, adjust the trade so we can let the trade breathe and try to maximize our profits further as price keeps moving in our favor to different key levels. The third option is an option that you have if you're trading multiple contracts. Generally speaking, with this option, it would be for trading 3 option contracts or more. Now, one thing you would do want to keep in mind with this indicator, the new V3.0 version of this indicator also works on the SPX mini index, which is the SSP symbol. Now that index trades at 1/10 the value of the regular SPX index. So for those people that are generally confined to trading because of their resources and account size and how much they want to allocate to a trade, if you're generally looking at you only trade one SPX option at a time, you may want to also consider trading XSP options, as those options trade at 1/10 the value because it is an index that trades at 1/10. It is the mini SPX index. And those situations, if you're trading XSP and you're normally trading one SPX, regular SPX index option, you can instead take the same amount of money and now trade 10 mini SPX index options on the XSP index, and that would give you the ability to have more control over scaling out of your trades and trying to maximize winners as price continues to move in your favor and you keep adjusting regular trades. So just something to keep in mind. The V2.0 previous version did not work on the SSP, but now this V3.0 version also works on the SPX mini index, the XSP. Okay, so moving along here on the 9:44 a.m. candle, we have, going back to, before I do that, let me go back to the last point I was trying to make before we went into the SPX mini index. And that is on the third option here, you have, if you're trading multiple options, generally speaking 3 or more, you have a third option with a regular trade, which is to exit somewhere between 65 to 70%, up to 90% of the options that you have, that you started out with, and then adjusting your stop loss to break even or break even plus a minimal profit buffer at the beginning on the remaining runner contracts. And then the idea is on that you're de-risking the trade. You're already taking off a majority of profits from somewhere between 65% to 90% of the option contracts that you started out with because you're exiting those at the 1.5 level move. But then you're keeping the rest as remaining runners to manage throughout the trade going level to further key levels to start maximizing your profit on the remaining runners. So that is an option, another option that you have with a regular trade if you're trading multiple contracts of 3 or more. Okay, so here on the 9:44 a.m. Candle, the mid S1, S2 hit, the bid prices on the candle close on the 69.55 put 35.10, profit 1,050 per contract, 69.45, 28.70 on the bid, profit $900 per contract, and the 69.35 is 23.30 bid on the candle close, profit of $770 per contract. Now, on regular trades, you can also wait for the two-level minimum ideal move to hit before making any adjustments or doing one of those three options we talked about at the 1.5 level move. It's just the 1.5 level move is going to be your minimum required threshold, whereas the 2-level move is the minimum ideal move. So the same options would be here at this 2-level move. Again, how do we calculate how many levels the move is in our favor? It is from the level that we're basing the trade on, in this case the bull bear KPL, looking in the direction of trade, which in this case is down. We have a 1-level move, 1.5 level move. The S2 is the 2-level move. Now also, once you get past the 1.5 level move in your favor, if any of these levels happen to fall after or be in the direction of the trade after the 1.5 level move occurs, these levels, whether they be the YDL, PML, YDC, YDH, or PMH, also become additional waypoints for decision making, in addition to the other key levels that would be waypoints as we're going through the progression of the trade here. So in this case, the YDL level, as you can see here, is very close to the S2 level in this day. So we have confluence with those two levels. And in this case, on this 10 a.m. candle, it takes out both of those levels. So we have an S2 hit and a YDL hit on this 2-level move. The bid prices on the candle close here on the 10 a.m. candle, 69.55 put, now 44.20. Profit $1,960 per contract. 69.45 is 36.70. Profit $1,700 per contract. 69.35 put 29.90. Profit $1,430 per contract. Here at the 10:16 a.m. candle, we have a hit of the mid S2, S3 level. This is now a 2.5 level regular trade extended move for remaining runners. So again, we have the level we're taking the trade from, 1 level, 1.5 level, 2 levels, now 2.5 levels at mid S2, S3. Here we have the data boxes for the bid prices on this candle close of the 10:16 a.m. candle. The 69.55 put is now 67.90 on the bid. Profit $4,430 per contract. The 69.45 put is now 58.80, a profit of $3,910 per contract. The 69.35 put is now $50.30, a profit of $3,470 per contract. At 10:20 a.m., we have a hit of the S3 level. That is now a full 3-level move in your favor. Again, calculating from the level we're basing the trade on, looking in the direction of the trade. Now this is the 3-level move in our favor. Again, a 3-level regular trade extended move for remaining runners. Bid prices on the candle close are down here. 69.55 put, now 85.90 on the bid. Profit $6,130 per contract. 69.45 put, 76.30 bid. Profit $5,660 per contract. 69.35 strike, 67.10 profit, $5,150 per contract. Okay, so as you can see here, if you're a scalp only trader, you're looking for 1-level moves. If you're looking to do regular trades and you're looking to do extended moves, you can see the power of compounding your profits, de-risking the trade on the earlier TP levels here, leaving remaining runners that you can adjust or exit at further moves in your favor, and how the profits can greatly magnify by leaving some remaining runners in a trade so you can take advantage of expanded profits as the trade continues to move in your favor and you manage those trades level to level. Now, as I mentioned earlier on in the video, if you would like to know more about how this indicator works, the daily key level strategy, and you'd like to see other videos that go into more detail about the indicator and how it works, please look in the description of this video on YouTube, and you'll see links to other session videos, and you'll also see links to a general overview of the SPX daily key levels indicator, and also a features video, a link to a features video on the new features found in the V3.0 version of this indicator, which was just released about 10 days ago. Now, if you're interested in purchasing this indicator, you can email us at daytradinggps@gmail.com. And in return for you taking your time today to watch this video, you can request a discount promo code, which will give you a substantial discount on the purchase of this indicator. Now, you don't have to take our word for it as far as how well this indicator works. You can go to daytradinggps.com and you can look at the feedback from traders that are using this indicator, which here we've highlighted some of the feedback that we've received from people who are using this indicator every day. So you can take a moment to look at these. You can also go ahead and go to daytradinggps.com and you can look at the reviews on that site. So again, thank you for taking the time today to watch this video, and we wish you much prosperity in all your future trading. Thank you.